I want to get back to the yuan. We've got a wealth of charts on this. Matt and I have already showed a couple, but here's another one showing China's one-year rate swaps falling below their US peers for the first time in 9 years, even though we had that move from the PBOC to make shorting the yuan more expensive. Are you still shorting the yuan, would you?
We're neutral to currency right now. We had been short the currency. We recommended that clients take profits on this a couple of weeks ago, given the speed of the move. But if you ask whether there's a good hedge for trade sanctions becoming a more binding constraint on the economy, to me, it's definitely the renminbi. And second to that would probably be something like the Korean won, because a consequence of that trade policy becoming more binding on growth is that the PBOC could ease even further. That reduces the rate spread to the U.S. and drives the currency down.
So for you, this is very much sort of trade-driven, the reason that you would see the yuan continuing to weaken.
Exactly, because if it weren't for trade, what you'd probably see is Chinese markets starting to track U.S. markets higher. The sectoral composition is essentially that of a tech-dominated equity market, and because U.S. techs are quite firm, I think...
The rate divergence has been growing.
Well, it is, but you'd have an offsetting capital inflow, I think, from the equity side. So I do feel like what's going on in the currency is almost 100% a function of trade, and if that were not present, you'd have a much more balanced capital flow picture and a much more stable currency.